Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we got some great topics to make you a smarter investor. Gonna talk about yet another warning on private investments. This is so important. I know, well, gosh, I keep talking about that. This is so important because I do believe if we don't fix this, we're gonna have a major blow-up years down the road that will surpass the Great Recession of 2008 because it's not a good trend the way we're going, but we'll talk more about that. Also, too, I know it's going in September here pretty close, and will tariffs hurt this holiday season? Yeah, we're talking about holidays already. And you're going to love this one. Should you work in retirement? I'm sure you have your thoughts on that. We'll tell you some things that maybe you like, maybe you don't like, but we'll discuss them. Chase, what do you got?
Companies we're going to take a look at today includes Cracker Barrel. They were kind of the spotlight, I guess, the last couple of weeks in terms of their logo change. Also going to look at Zoom Communications, Ralph Lauren, and then Viking Holdings, which is the cruise line, not the pharmaceutical company. So excited to break down those numbers, see if there's any potential buys out of those four companies. And, well, as always, look at the valuations, the balance sheet, and give you our opinion if we think it's a buy, sell, or hold.
Let's dive right into it. Should you work in retirement? I know a lot of people like, your working years, I can't wait to retire, take it easy. You just can't wait for that to happen. Like, what can I do when I retire? Well, for some people, I will say retirement has worked out well, but not doing very much. But science has shown that there is health benefits to working in retirement along with financial benefits. And the health benefits, would include more physical activity. I mean, think about it. You retire, you get up late, maybe you mosey on over to the porch, sit in the rocking chair, don't do very much. Not very healthy for you. Instead, when you work, you're moving around, you're staying active, you're walking, taking steps, going up, down stairs. Much better to be working for your health and when you retire.
Yeah, and I know there are, good jobs where, again, you're not just sitting at a desk all day, so you can get more physical activity there. But the big thing that I think is interesting is, and we see it so many times where, we have clients in their 80s and they're active and they, we actually just met with a gentleman this past week and he's like, well, how old do you think I am? And I didn't guess, but he's like, I'm 87. And I was like, no way.
I thought it was the 70s.
Yeah. And, he wasn't working any longer, but he dances all the time. Yep. And you listen to him speak, and he's always doing something. And I say that because if you're still working, while he wasn't working, I have seen other people working. He's active. And that activity keeps you connected with other people, which I do believe helps extend that life. And I think it extends maybe the number of years, but also the number of good years as well.
And we've had people that are very active volunteering and doing things. And when we talk about working, again, we're not talking about, being stressed out for 50 hours a week at work. Yeah. We're talking about, and some people actually have went to a second career that they want to do all their life. Like, I want to do this. Well, they do that because they enjoy it and they don't mind working with that.
And I do think as well, when you look at the financial benefits, there are financial benefits that come from working your later years. Includes taking out less from your retirement accounts to maintain a good lifestyle. Also, you can hold off on Social Security, which means you get a larger Social Security check when you do decide to collect. Obviously, you wait till age 70. Well, those benefits accumulate, and you're not I don't want to say wasting, because collecting Social Security early does have benefits if you use it properly. But if you don't need the Social Security and let it accumulate, it's nice.
And actually, that's one thing our financial planner, Harrison Johnson, talks about. That sometimes makes sense to delay it, sometimes it doesn't. But these are things you kind of look at. That it gives you the option, not I have to take it because I can't afford to eat if I don't get that Social Security. But do you want...
Yeah, and I know you were kind of talking about too. A lot of times people they'll start that second career in retirement.
Yeah, and I've talked to clients where they're like 75, 78. Yeah, I'm just doing bookkeeping now. I'm doing this, but they're very happy because they're talking with people. But the type of work, it depends on you. And some people in retirement, as I said, they start a second career. But some people just need to work part-time doing something because to be active, be accountable to people, talk to people. If you're in retirement, you don't have to take a high stress job. As I said, take a low stress job. So you're not stressed out like, oh, I hate going to work. That's not what it's about. But you get that income to help cover your expenses. And again, you can put some of that money away even when you're retired. So it just gives you a much better stress level by working. But again, we're not saying, do a stressful job. We're saying do something you love to do.
Well, and that is the benefit of planning for retirement.
Yes.
Because you don't want to have a stressful job in retirement. You want to have the option of working, not working, maybe too, taking something that's not paid. You don't have to take a job that's paid if you don't need it. And I always kind of tell people, it's like, gosh, if I was, let's say early, mid-60s and I was able to retire, I might just go back to coaching high school football, 20 hours a week, and that might be perfect for me. I wouldn't collect a paycheck for that, but that would keep you so active, and it would keep you engaged with a younger group of kids out there.
Right.
And,
and there's actually some high schools that pay, not just volunteer.
I think when I was at Poway, they offered me a $1,500 stipend. You work probably 20 hours a week for 6 months out of the year, so you're like, 1,500 divided by 6, it's like you're getting paid $2 an hour.
Yeah. But if you're retired, it could be a vacation fund. Like, okay, now I'll go on vacation with that 1,500. So, but let's move on, because I want to talk about another warning on private investments. And as I said, we do warn about these a lot. These are terrible. I remember hearing about a company by the name of Yieldstreet a few years ago, and how it was a new way for small investors to get access to private investments and diversify away from stocks. I don't get that. Why diversify away from stocks? If you pick the right ones, are pretty good. But the company promoted their platform with a tagline, invest like the 1%. Well, what do they mean by that? They're saying invest like the wealthy. And I hate that sales pitch.
That's all it is.
Yeah.
Sales pitch. I mean, it just irks me when I see stuff like that. And then especially, you don't want to be all in stocks. And it's like, why?
If you pick good ones.
Yeah, you pick good ones, exactly. But that's a selling ploy to a lot of people. People that got burned years ago in stocks, and they're like, yeah, I probably shouldn't be all in stocks. So, yeah, I'm going to try this new thing, and, I get to invest like the 1%. And it just... we'll get to the story on maybe why it irks me even more. Several investors may have lost everything they invest in the platform. One gentleman shared with CNBC how he invested $400,000 in 2 real estate projects. One was a luxury apartment building in downtown Nashville, and it was overseen by former WeWork CEO Adam Neumann's family office. Number one, I don't know why we would have gone with that, because that guy kind of had some issues when he was running WeWork, but that was a huge collapse that happened. But, I mean, you hear the word Nashville, and Nashville was a hot place, and apartment, what could go wrong? And then there was also a 3-building renovation in the Chelsea neighborhood of New York, and this is what allured this gentleman in particular to this investment, was that each project had targeted annual returns of around 20%. Wow, that can't be risky, right? Well, unfortunately, after 3 years, Yieldstreet declared the Nashville project a total loss, which wiped out $300,000 of its funds, and the Chelsea deal needs to raise fresh capital, or it will face a similar fate.
And, and people hear real estate, and they hear that 20%. I've seen them like, well, that's a good return. But I think you said the words you used was targeted return, right?
Targeted.
So it's
not guaranteed.
Not guaranteed. And again, if it is, people say, well, it's guaranteed. What is it guaranteed by? A company or a real estate development company or somebody that... It's not like the government guarantee where the government have to go broke. I mean, these guarantees I come up with, like, it's only backed by as good as that company is. And many times they're so leveraged and so much in debt, they can't make that guarantee for real.
That's how you lose the money.
Yeah.
Is that the project could be potentially profitable, but they leverage it and they put all this debt on it. Can't repay the debt, and then all of a sudden it's gone.
Yeah.
And it disappears. And the debt is just such an awful thing. You don't think about that when you're doing these deals. And it just drives me crazy when I see people do these things. And I'm going to say this is the fault of many investors as well. You hear all these things and you think that this is different, that you're going to get a 20% return, when this basically happened when the 10-year treasury was maybe around 3%.
Right.
That is the only thing out there that I would constitute as risk-free. So you're getting nearly 7 times the risk-free rate. There's risk in that. Come on, man.
And I learned a long time ago, if you can double the risk-free rate, you're doing pretty darn good. And we generally tell people we'll average 8, maybe 10, maybe 12% on average. So we're in that line there. But, Chase, what's a shame is he's not alone. And CNBC reviewed documents that show investors put more than $370 million into 30 real estate projects that have already recognized $78 million in defaults in the past year. And Yieldstreet customers, well, they weren't very positive. They said, they spoke to CNBC. They said, well, we anticipate deep or probably total losses of the remaining amount that we have with them.
Yeah, the remaining $300 million is still in question, and they think that'll disappear too. And when I looked at this platform, I mean, it's not just real estate. There was also private equity, private credit, art, crypto, and other less common investments. I even saw one, they were doing financing for some boats, for some like massive ships that just got lost in the ocean.
Oh, wow, that's a good investment. Gee.
And it's like, what the heck? And I mean, Yieldstreet, they make their money by charging management fee of around 2% on invested funds. So it was a heavier management fee as well. But the craziest part to me was in several cases, Yieldstreet went to its user base to raise rescue funds for troubled deals and told members the loans combined the protections of debt with the upside of equity. But in one case, a $3.1 million member loan to rescue that Nashville project was wiped out after just a few months. So let's phrase it this way. We failed. Can we get some more money to try and fix our failure? That's basically what they're saying. And then just months later, oh, we failed again. We're so sorry. I mean, it's...
and these people are such good salespeople. They can, sell you oceanfront property in Phoenix. I mean, that's how good these guys are. And when you hear, our warning is, we're telling you, we're backing this all up, but our warning is when you hear private, I don't care if it's real estate, private equity, private loans, stay away from it. I mean, one of the big problems with these platforms is professional large investors are more disciplined when looking at investing in this space than the smaller players, maybe getting the bad deals that are passed over by the more established players. So they're getting the low-hanging fruit, I guess, is what they're getting. It's unfortunate to see people lose money like this, but this is why we avoid, at Wilsey Asset Management, we avoid 100% the private investment space. There's just not enough clarity, and in many cases, these platforms seem to be in it for themselves rather than for the investors, trying to just rake in the fees. We will continue at Wilsey Asset Management to invest in good quality equities, as I worry we'll continue to hear stories like this from investors who put money into private investments thinking they were investing in a safer asset, just to find out years later there's nothing left. And we've talked about the difference between risk and volatility. This is the risk when you get into these, and it's just such a shame that people like, oh, equities are risky, but I found this thing here, no market fluctuation, because it doesn't trade. So they don't know what the value is. And some of these put on their own stated value, like, well, we think it's worth this.
Yeah, so you're charging 2% on a fake value, basically. Yeah. It's not a true market value. It's, again, an estimated stated value. And we had another piece in the newsletter about the Ivy League funds, and all of a sudden they didn't actually get that stated value when they had to go sell. So you make that question of, well, then what is the true value of it, even though they're charging this higher management fee? And the other thing that I thought was interesting with this Yieldstreet platform is the gentleman that spoke out on CNBC said, at first it was fine. Of course, that's how it generally goes. He was getting these statements and he was getting kind of updates. And then what happens? It's a private investment, so it's not required. It starts disappearing. You're not hearing anything. Can I get my funds back? No. And it's just like, oh my gosh. And locking your money away to anything with no guarantees, it just, I would never do it. I mean, again, I'll buy a stock and maybe even that stock goes down, let's say 10% because it was a improper investment. At least you can cap that loss at 10%, or things change, right? COVID happens, we can get out, we can get into something different that, is not going to bleed to zero. The private investment, you have to.
Right, but we can look under the curtain. We can see the cash flow. We can see the balance sheet. We can see the income. We can read that, maybe it drops down 10, maybe even 20%, but we can say, wait a minute, this is a short-term problem. Let's buy more of this.
I'm even saying...
Well, but I'm saying with the private equity, you can't see anything. You don't see behind the curtain at all. It's a blind curtain. You don't know what's going on behind the scenes.
But I don't want to say we're perfect. I mean, again, I always tell the example of Carnival Cruise Lines. We bought Carnival in 2019. Right. We had no inkling that COVID was going to happen. Totally changed the business. we did sell Carnival at a loss in the portfolio, but we were able to get out. Difference is if you did a private investment, let's say that just bought cruise liners in 2019. No, sorry, you can't get your money back. You'd probably still be in that fund, or maybe you'd be out of that fund because your money be at zero. I mean, it's just something that the private investments, they can go great for years, but the moment things turn on a dime and all of a sudden they go down, you can't get out.
Yeah.
You're screwed.
And didn't you just get a call? We got a call from somebody that is in that situation where they did a private investment and it's 4 years? And
yeah, 4 years. He's getting a nice 10% yield on it initially. Right. You know, that's how they're sold. And sure enough, the yield stopped coming in, and now he can't get his $125,000 because it is locked away in a private deal.
And I saw this back in the 80s. They're called limited partnerships, where it starts off pretty great. You get the yield and everything else, and all of a sudden, you're right. It just like the yield stops, try to get your money back. And sometimes people don't get their money back, if they got anything back, for 10, 15 years. And they go through court. And by the time you go through court, sorry, the attorneys eat up all the whatever is left there, anything, and you get zero out of that investment. So,
and I just want to add one more thing to that point about how the larger investors are many times passing over these deals. So I kind of use this Nashville and New York deal I mentioned. I bet you a lot of larger investors looked at that deal. They ran the cash flow numbers. They looked at the details and said, that deal doesn't make any sense.
Right.
So you're not truly investing like the 1%, because the 1% says, no, we're not going to buy that. That's a bad deal. But if you're a smaller investor and you're part of this, I'm going to call it basically a crowd platform where there's a bunch of people that put all in little amounts to try and get into the bigger deals like this, that money has to go somewhere. So are those people really going to look in detail to see what are the metrics, what's the cash flow, what are the good details of this? And then like, oh, shoot, we have, again, $400 million. We got to put it somewhere. So let's go buy that one thing that is available for sale.
And Chase, you bring that up, but you can't. When you look at private investments, you can't see the financials.
I'm saying, I think that, again, if you are truly wealthy, right?
The 1%,
if you're doing these deals on your own,
you are looking at that stuff.
You're looking at that stuff.
Because
if you're part of a fund, you're not going to know that. And the fund manager, they're not going to be like, well, we don't have anywhere to put the money, so we're just not going to do anything right now. No, they're like, oh, we have $400 million. We have to invest it in something.
We got to do something with it. So, and again, it's a private. You can't see what that private investment's doing. No. It's just, that's why I say stay away. This will blow up. And again, we've had a good economy here. Just wait till things slow down, and they will. You have these slowdowns. That's when this can be magnified. So if you're not in these
inklings of them,
and I'm gonna say if you're not in private investments, don't get into them. If you're in them, if you can, try to get out. But you may be in for a surprise. Let's talk about the holiday season, because tariffs hurt this holiday season. It is already the end of August. Actually, next week is September. And before you know it, you'll be thinking about putting out the Christmas lights and decorating your home. Well, for the past few years, we have seen growth in holiday sales. And again, I want to point out sales. That's important. But this year could be different, as it appears from recent conference calls and the CEOs at Walmart, Home Depot, and Target, that they're seeing the tariff increases starting to come through. And what we have to look at, retail sales, there's no such thing as retail profits, but I think that's what the problem is going to be.
Yeah, and I mean, kind of using the example of the Walmart CEO, he did say on the conference call that the impact of tariffs has been gradually increasing to protect the consumer. But he also said that the company is seeing cost increases each week as it rebuilds inventories with new products post-tariff. Very important, because when we are initially kind of looking at these tariffs, companies built up their inventories, they were working through prior inventories, and now they're like, oh, shoot, maybe these tariffs lasted longer than we thought. Now they are having to kind of deal with the tariffs as that inventory runs dry. He also did mention that they may not be able to protect the consumer from rising prices much longer.
And again, what worries us is that inventory, as you said, it's kind of dying down. By the time you start shopping for holidays, the tariffs could be at full tilt, because all that inventory is gone. And I remember, too, the holiday sales, the products, they're usually shipped in August. And that's when they get to the, October, November, and so forth. Well, what happened in August? Tariffs were there already.
Yeah.
So be prepared for higher prices on holiday goods. But what's also bad about this is retail sales may rise, but consumers will receive less product to put under that Christmas tree. And considering sales are not adjusted for inflation, This could be delayed inflation that Jerome Powell and the Federal Reserve has been waiting for. And unfortunately, it may show up when people begin shopping for Christmas gifts. Maybe there should not be an interest rate cut in September after all. And I know you kind of think there should be. You're kind of
No.
No, you don't. What do you?
I said I think they will.
You think they will? Okay.
Yeah.
Right.
I think
I don't know why he will, because he's going to March anyways. Why cave?
I think it's because if the market prices it in at 90%, that will be a shock to the market.
Right.
And why the market? I mean, that's the question. Should they follow the market? I mean, you're supposed to be independent, but I think they will. And I've been, I think, pretty vocal that I thought that we should cut rates, and I think I had a little bit of self-fulfilling bias in this. I have my mortgage, and I'm like, it'd be great to be able to reduce my rate. We also do have a flooring company in the portfolio that would benefit from that. So I mean, we have some assets that I think would benefit from a rate cut. But again, we're long-term investors. I don't need the rate cut tomorrow. If it happens next year, even I'd be fine with it. But I have started to maybe question that. Do we need rate cuts? I mean, I don't know. I mean, do we really know the impact of tariffs? And I still want to emphasize the point. I don't think they're going to be as bad. Inflation is not going down, I don't think, 5%. But I don't think the tariffs are going to allow us to get down to 2%. So do we need to cut rates in September? I don't know. I mean, I think we could wait until next year, and it's not going to, I don't think, change things long term. But the problem is people are so short-sighted.
And also, too, last week we talked about 3 data points coming out of PCE, which came out Friday, 2.9%, well away from the 2% target they want. We still have the CPI and the jobs report coming out before they meet again. So if those don't come in well, and again, if the jobs report comes in very good, that's a problem. CPI comes in higher, that's a problem. I really hope that Powell listens to the data and doesn't cave. And if the market does, why are we sitting on 25% in cash in the portfolio? Because we're prepared for this. And if your portfolio is not prepared for a downturn, you need to look at the valuations of what you're buying. So I want the Fed to do the right thing, and I don't believe an interest rate cut is the right thing for now.
And I think, again, it was kind of a little bit of clouded judgment potentially on my part. But if you actually look at the numbers, I'm not seeing, I guess, the reason yet to cut rates.
Yeah.
I don't see the necessity to rush to do so.
Right.
And it's like, oh, we're having a slower housing market. I mean, housing prices skyrocketed.
Yeah.
So it's like if you zoom out and over the long term, over the last 5 years, housing prices have gone up a ton. So it's like we've really distorted the market, and we've gotten people accustomed and addicted to cheap money, which is not good, I think, the long term. I think they cut rates too fast. I think you're just going to expand this bubble, and maybe it staves off this problem for 2 years, but I think it makes that problem maybe 5-6 years down the road a whole lot worse.
Well, all this information comes from our newsletter. It goes out every Friday at 5 o'clock by email. Other topics we talk about in the newsletter that you'll see is why Bitcoin could never be a world currency, who benefits from private investments in your 401k, not you. We'll explain more on that. Why is the union trying to get into JP Morgan Chase? That was a funny story. Waymo's autonomous taxi services will now be available in New York City, and also San Diego is coming here as well. I read it also. Ivy League schools don't appear to be the best investors, and Europe, well, they're far behind in the economy. All this on our newsletter. Go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You read it, you'll become a smarter investor. It's free. Sign up for it. All right, let's talk about who we talking about first here. Is it Cracker Barrel? All right, gosh, that was in the news a lot. Let's go to the numbers and talk more about the news here. They're in the restaurant industry. Wow, 31.5% short on the stock. They think this stock is going to drop dramatically. P/E ratio doesn't look justify that. It's 23.2 versus 30.5, and you want these numbers lower. Price to sales, 0.4 versus 2.4. Price to book value, 2.8 versus 16.9. And price to cash flow is 7.2 versus 17. So the valuation ratios look pretty good. Over the last year, earnings are up 41% versus getting at 1.7. Sales are up 1.1 versus the industry up 3.1. Now, for some reason, the analysts on the 5-year earnings per share growth estimate a negative 126% versus a positive 6.5%. So I'm not sure why that's happening here. You'd want to find that out. They do pay a decent dividend of 1.7%, using 38% of their earnings to pay that out. And then look at the balance sheet, current ratio 0.7 versus 1.2. That's a little bit low, especially When you look at debt to equity at 2.4 versus 1, and then we see a net profit margin of 1.7 below the industry at 7.9, and return on equity is 12.3. So on free cash flow could be a problem here. Only 25, I believe that's million versus 2.9 billion for the industry. What do you got going for it?
Yeah, I was just going to say real quick. I mean, they were in the news because they announced a new logo, and then they took a lot of backlash for it. I mean, the stock, I think, went down like 10% on the announcement of the new logo. And then they said, okay, actually, we changed our mind. We're not doing the new logo. And the stock went back up like 10%.
I think it was masking the financial information, maybe.
I
don't
think
know.
so. And I mean, people were pretty disappointed with it. It looked like there was a poll that had 65% of Americans were aware of the new logo, and then 76% of those people preferred the old one. So people didn't like it. Even President Trump weighed in and said, change it back to the old logo. But again, they're not going forward with the new logo. And to me, I looked at it. I didn't see all the outrage. It looked pretty darn similar to me.
Did it change the taste of the food or the service or anything?
I don't think so. But let's look at the numbers here real quick before we have to go to break. Current price for Cracker Barrel, again, their ticker symbol is CBRL. It's $59.82. 52-week range, the low here, $33.86. The high, $71.93. I look at this company, though, over the last 5 years, it has not done well. The 5-year return down 55%. 10-year return down 59%. I mean, it has definitely struggled over those different time periods. Going forward for the business, though, I go out to July 2026 as they report on a fiscal basis. I see estimated earnings per share of just $3.33. I mean, it gives us a target sell price of $55.28. It's still expensive, even with that decline, trading at around 18 times future earnings.
And this is a prime example of why not to buy high-value stocks. I see even the earnings are up from 9 days ago to 310, now at 333. So everything is looking good, but this company is just too expensive. This is why you do not buy high-valued companies. Even when they pay a dividend, you've got to understand what you're paying for something. And I would love to buy a Cracker Barrel restaurant. Sounds pretty good, but not these prices. I think it'd have to go probably down to what, probably 30, 35 before we
I don't know, too. I mean, the tariffs could have an impact on them. They are a restaurant, but I don't know if you've ever been to a Cracker Barrel.
I haven't. I think I have, but I'm not sure.
There was one in near Flagstaff, Arizona. So that's the only time I went was when I was in college. We'd go there sometimes. It's like a whole store inside. So like half of it's a store that's got like gifts and kind of candles and like kind of this old country vibe is the whole thing they play off. And then the other side is the restaurant. So I don't know. Tariffs could be something that's impacting them as well.
Maybe, but be careful. You look at a Cracker Barrel. All right, we can take a break. When we come back, coming up is our financial planner, Harrison Johnson. He's a CFP. Talking about the challenge of creating retirement income. He always has great information, so stay with us. We'll be right back with Harrison Johnson. All righty, welcome back to Smart Investing Show, and this is the part we talk to our financial planner, Harrison Johnson, the CFP. Always has great topics. A lot of times, like, no, Brent, you don't qualify for that, but you always have great topics for everybody else, so I appreciate that. Today we're talking about the challenge of creating retirement income, and when I saw this, like, I know this is a big problem for a lot of people, isn't it?
It's a big problem, and a lot of people don't think of it as a problem because you go from working and accumulating money largely, you're putting money into your 401k every 2 weeks or whatever it is, and you do that for a few decades, and you wind up with this big pile of money, and now the question is, what do you do with it? Well, I've got a lot of money, so it's going to be fine. Well, the actual creation of income from assets is a lot different than what it is when you're working and just adding to it. So doing that efficiently means, you don't run out of money, or you get more money out of your assets than, hopefully enough to live on and have the lifestyle that you want. So a lot of people look at different things of putting their money in when they retire. CDs and treasury bills have been a little bit more popular recently because the yields are slightly higher than they have been, but they're 4% or so. But you're not getting any appreciation from that, so they're not inflation adjusted, and short-term rates are probably going to be coming down at some point. So 4% now might be 3 or 2% at some point in the future. So it's not a consistent long-term income stream. Corporate bonds are another thing that people look at to create income, but really the long-term return of them isn't that much greater than CDs and treasury bills are. And they have all the risks: interest rate risk, credit risk, duration risk, reinvestment risk. So you might get a little bit more long-term return, but you can lose money in bonds. So, the 10-year return of bonds has not been good at all. Yeah. Annuities is something else people look at. Annuities are basically pensions. You can create pension-like income with annuities, but now you're doing it with an insurance company, and they're creating those to benefit themselves, not you as the investor. So you really don't make that much money. In many cases, you lose a lot of money with annuities in terms of the income stream, because you have to live so long just to get the money back that you put into the annuity.
And that's because the inflation adjustment. I mean, it doesn't keep pace with inflation. I mean,
usually they don't. No,
right.
You can get an annuity through an insurance company that has an inflation adjustment, but that means you're starting out with much less. So, it's all actuarial tables. And again, the insurance company is doing it to make money. And so, here's $500,000, here's $1 million insurance company, and they'll give you some of it back. And if you live to be 300 years old, you'll get money back. But if you don't, in many cases, you can lose money. The break even is 10 to 20 years in many cases on those things, and then only then do you start making money. So your actual total return is never good, because the yield is just it's impossible based on the yield that they give you. Another thing people look at is, well, I'll just invest in high dividend stocks. So maybe that'll work out. And that sounds a lot better than it really works out to be in practice. And one of the problems that you have with dividend stocks specifically is, in many cases, companies that pay high dividends might be struggling and stock prices might have come down. And so the dividend yield might look high, but that's only because the stock price is down.
Right.
And so, because of that, if that company is struggling, if you're not looking at all the other fundamentals of it, and they are forced to cut the dividend, well, that can hurt the stock price even more, especially if people are holding that purely because of the dividend yield. So if they cut that out, those investors go elsewhere. And, long term, you can, be chasing yield and not really make that much money if you're only looking at that. The opposite side of the spectrum is, the NASDAQ, the S&P, things like that. People have done well investing in those, especially if that's in your 401k and you just put it in there and it's grown, not to mention the risks that you guys have talked about with the earnings and the concentration and everything else. But the dividend yields on those, on the S&P, dividend yields like 1.1, 1.2%, and the NASDAQ, it's like 0.8. So it's really not much at all. So if you're needing income, you have to sell, and you have to sell a lot consistently. So now you're trying to time when to sell, how to sell. And if you do that inefficiently, you can deteriorate your portfolio if you're selling at the wrong time, or if you need to withdraw money because you're in retirement, you sell at the wrong time, that can really hurt you really quickly. Even like dividend aristocrats that a lot of people think are great investments, and, depending on how you do it, I guess they can be, but dividend aristocrats are companies that have a history of increasing their dividends over time, but the yield on those aren't as large as you might think. Dividend aristocrats, if you look at all of them, the average yield is like 2 to 2.5%. So it's not like a 7% yield that's increasing all the time. The reason it's able to be increased is because it's the initial current yield really isn't that high to begin with. So if you want more than that, which a decent income portfolio should be able to pay out more than 2 to 2.5%. So all of these things need to be looked at. But the fact of the matter is, creating income is a lot, I would say, more difficult, but it's just a lot different than accumulating money when you're working. And so if you're planning for retirement, you need to have an idea of how, one, you're going to invest that money, and then how really you can sustainably withdraw from that to make sure you don't run out, but also you're getting as much money out of your assets as you possibly can.
So what happens? Joe Smith comes into you, says, okay, I've accumulated all this money. Now I want to retire. what do you look at to say, okay, this is how we're going to get you so you can have a nice retirement? I know people get scared because it is going to reverse. So now they're taking money, not putting money in. So how do you handle it?
Well, a lot of people struggle with it because if they don't have a plan, the financial plan is a piece of this, but this really works in tandem with the investment plan that you have. So really, both of those need to be working well together. But if someone comes in and they don't have a financial or an investment plan, in many cases, they're just afraid of how much really they can withdraw. And I mean, if you never withdraw any money, you're never going to run out. But what's the point of working for 3-4 decades if you're never going to, use the money that you spent all that time trying to accumulate? So when someone comes in, we need to talk about, yes, what is your plan for your assets and really how much money do you need? If we can, put those assets in a place, or maybe talk to you guys depending on the situation. Yes, we need that money to grow. Here's how much income we can reasonably withdraw. Also, this is how we will use that to supplement Social Security and when you should collect Social Security. This is how we should, how much we should be withdrawing from the different types of accounts that you have to keep an eye on, the tax perspective, should any be converted. All of those things come into the plan. But at the end of the day, the financial plan around retirement is how do we get you to retirement with the most income and pay the least amount of taxes on it?
I would just say kind of two things that stood out to me there was obviously you talk about the NASDAQ, and I've kind of hit on this, but I just want to reinforce it is, the NASDAQ could have been a great investment during your working years, or the S&P 500 could have been a great investment during your working years if you lived during the last 20 years. But now all of a sudden you switch to that income side. And if your plan is to just kind of take from that investment, again, I like to point out the tech bust. The S&P fell by 50% and the NASDAQ fell by 79%. If you're withdrawing income from a portfolio that crashes 50% and you're fully invested, you're going to run out of money because you're going to have to cash in at low periods. So it's structuring that portfolio is so important. And then I want to hit on dividend stocks real quick too. The most recent one that comes to mind is Dow Chemical. Dow Chemical right now has a forward dividend yield of about 5.7%. It was around 11-12%, but they cut it in half. But that's not the full story. Dow Chemical is down about 54% over the last year. So when you bought it, let's say at the beginning of last year, or 1 year ago, just keep the numbers easy on me, you bought it 1 year ago, you were getting around a 5-6% dividend. Well, now you've gone through a 50% collapse in the stock price, and now your dividend is not 5.7 because that's based off the current price. Your dividend's more like 2.5 to 3% after weathering that 50% plus decline. So you're not going to be at break even because of the dividend. I don't think ever. You're going to need that stock to come back. But it's a difficult strategy that I think a lot of people think sounds easy, but it's not the full story that you need to follow as an investor.
Yeah. And I just want to kind of let that sit for a little bit because it is important to understand, because people get so excited about things and so emotional. And that's what happens, Chase, when that Dow Chemical drops, 20, 30, 40%, people will panic and sell, and they may sell everything else. Like, stocks are risky, I'm going to get out. They did a silly thing. You've got to understand, because we love dividend paying stocks, but we look at the income statement, we look at the balance sheet, the cash flow, we look at the payout ratio, all these things to make sure that this makes sense. And if you're not doing that, you're just poking in the dark. That's all you're doing.
And I mean, with the Dow Chemical, obviously not every company that has a dividend yield is going to cut that dividend yield, but it only takes a couple of those in a portfolio to really hurt your long-term ability to withdraw a sustainable amount of money. And that's the thing, the rest of your portfolio might be doing fine, but if you lose 50% on this one, 50% on that one, that's, offsetting the other gains that you have in the others. And so now you're just depleting assets as opposed to preserving and growing assets.
Well, the problem is, again, you sell out of that Dow Chemical, because they cut their dividend. Well, now you have half the money that you had before to invest in a different thing. You can't just go say, again, I'm going to use that 5% level. Well, I'm just going to go find something now yielding 10%. Well, oh gosh, that is not a good strategy.
Especially
a losing game.
Especially while you are withdrawing money because you're in retirement. So, I mean, when you go into the point of now you're not adding money because you're working, you don't have a paycheck anymore, you're withdrawing money. So mistakes are much more costly because you don't want to have to go back to work, or maybe you can't go back to work. So that's why you need this plan. You need to have a plan ahead of time so you don't make a mistake like that and not be able to fix it.
And that's why it's so important to have a financial plan. I remember years ago, they said if you don't have a financial plan, you just plan to fail. And you've got to have a financial plan because that makes it so much easier. You're not going to do stupid things. You got somebody like Harrison that's going to walk you through it. Things do happen. Okay, we'll take care of this. But you look at everything. A good CFP, a good financial planner. And again, there's people out there who have CFP behind their name and they're terrible. They just passed a test and that was it. They're not good financial planners. Listen to that person. Again, I always highly recommend. I mean, I think every client you have would give you a high recommendation.
I think so. I think so. And I mean, a lot of it too, as far as the income goes, is when we put an income plan together for somebody, we say, okay, this is how much you can spend. It's like, wow, that's actually a lot more than I was expecting. That's more than I'm making right now. I guess I can retire.
And you plan for the downturns as well.
Oh, yeah, absolutely. You have to. You have to. It's not, best case scenario, you can get by this. No, conservatively, this is what it can be. But that's a part of, you want to get the most out of the assets that you've done.
Right. That's the financial plan. All right, Harrison, thank you very much. Again, that's Harrison Johnson, the CFP. If you want an appointment with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You do get a 1-hour free consultation to see if you do need a financial planner. So I'd say take advantage of that because you may be surprised what you're missing there. All right, let's move on to what are you doing next? Zoom?
Zoom, yeah.
I was so excited about this because I know Zoom came out during COVID, went way up. I'm thinking maybe now there's a value play here. So I thought we'd take a look at Zoom, symbol ZM, then the software application. And we use Zoom all the time. I think everybody uses Zoom, don't they? Seems that way.
I mean, the problem is there's more competitors now. I know some people use Microsoft Teams. There's Google Meets. So I think Zoom is still the easiest to function. Like you don't have to have a Microsoft account. It's very easy. If like we send a link to somebody, just click it and join the Zoom. So I think they've got the best product personally. But
yeah. Well, let's go to the numbers on Zoom. Their symbol is, I love the symbol, ZM. Just sounds cool. PE ratio 21.4. That's half the industry of software applications at 58.3. Price of sales 5.4 versus 6.6. Price of book value 2.7 versus 6.9. Price to cash flow 13.3 versus 31.5. So these are valuation ratios. You want them lower than the industry average. Zoom does that, and they have a PEG ratio of 0.9, which shows you how much you're paying for the future growth of that company going forward. That's a very good number as well. Looking at the earnings growth of last year, they did very well. Over the last year, the earnings were up 35.7%, double the industry at 15.6%. Sales climbed by 3.6%, not quite as good as the industry at 5.4%. 5-year growth rate for Zoom from the analysts is a 16.7%, so that's pretty positive. Unfortunately, they do not pay a dividend yet, and maybe in the future they will, but right now they're still considered a growth company. And I say yet because I looked at the current ratio. It's 4.5 versus 1.7. They have a lot of liquidity on the balance sheet and no debt. The industry's at 0.5. So I like the nice balance sheet they have here.
Are they buying back stock? Can you see the stock buyback yield?
I don't see it here. I'm sure it's there. I can maybe look at it when you're doing your numbers there. But we do see and I love the net profit margin. Wow, 25%, doubled the industry at 12.4. Return on invested capital, 13.2. Free cash flow, 1.8. I believe it's $1 billion versus $2.9 billion, so that's good. So I'm liking what I'm seeing here. It depends on what you say, what we're going to get going forward.
Yeah, so current price here for Zoom, again, their ticker symbol is ZM. It's $81.42. 52-week range. The low here is $64.41, and the high $92.80 year to date. The stock's about flat, but this is where it gets crazy. The 5-year return down 75%. You ready for this? The all-time high for Zoom, October 18th.
Wait, let me guess. I don't see it in front of me. 500.
Kind of close. October 18th, 2020, the price was $588.
Wow.
84.
I knew it was
almost
ridiculous.
$600 a share. So, you know, I remember people are like, oh, you buying Zoom? It's COVID. You know, you got to buy Zoom. And it's like, I mean, who knows what's going to happen here? I don't think we're going to be at desktops forever just talking to the computers, but you know, I mean, obviously that didn't pan out if you bought Zoom back during the hype years in COVID. Now going forward, I mean, this is kind of where it gets interesting. You go out to January 2027, you see estimated earnings per share here of $5.93. I mean, it gives you a target sell price of $98.44. So it's around 13.5 times those future earnings. The problem that I'm seeing, very limited growth. Earnings growth is estimated to be about 5.99% this year and 0.9% next year. So you're not getting very much earnings growth. Sales growth is estimated to be about 3.5% over that time period as well for each respective year.
And I got a comment. This is why we look at two different companies that do the analysis here. The one I'm looking at shows earnings in January 2027 of $3.48. They have 11 analysts. The low is $2.90. The high is $4.56. So the one you're looking at, they must have some analysts in there that are very high to bring that up to like $5 a share. Or whatever.
What was your low?
$2.90.
So I don't have the 290. I think that's the big difference. My high is 644 and my low is 540.
Yeah,
I have 31 analysts. How many do you have?
11.
11.
Yeah.
Interesting.
So yeah, that's something that's
I don't think I would buy it, obviously, based off those numbers. But and the other thing too that worries me about Zoom is, again, I kind of talked about Teams. I talked about Google Meets. Do they have anything that is going to make it kind of exclusive, right? Like, kind of look at, is it going to be like GoPro, where GoPro was all exciting for a little bit, and then GoPro is not exciting anymore. I think it's a like multi-million-dollar market cap now. I don't know if Zoom could go that route where it's like, we're not going to acquire you. We're just going to do what you do better. And then Zoom would just collapse.
I will say one thing I think they have is a benefit of the name. It's kind of like with Xerox. Oh, just take a Xerox copy.
Or just Google.
Yeah. Well, what?
Just Google.
Just Google. Yeah,
Google
just Google.
it.
Yeah. So just Zoom me. You know. So they've got that, but that is worth something. But I don't like the discrepancy that we have in the earnings going forward. And also, you said the growth rate going forward does not look that good.
Yeah, I mean, if you're going to only be growing earnings around 5%, I want to get around probably a 10 times earnings multiple, not a 13.5.
But remember what I have here, the 5-year earnings per share growth estimate from the analyst is 16.7 for the next 5 years. So tough. Yeah. And again,
I'd rather look at the earnings estimates. Sometimes that earnings estimate over the 5-year period is going to be weird if they had like a write-off or something last year. It's going to charge that number. So I'm like, I don't think the earnings growth is that pretty.
Yeah. And what we look at too is like, if there's something wrong, we're not going to say, well, yeah, but this is higher, so let's go with that. We will always take the other side of the coin saying, you know what? Yeah, it looks too good to be true. We'd rather miss something that went up than count on something where the numbers are maybe too high and we got too excited. We look at buying things that are not risky and not on all hype, but based on values. Yeah. So, yeah. All right, should we move on to the next one?
Let's move on.
This one, I can't even think of her name. She's so popular. What is it?
Taylor Swift.
Taylor Swift. Oh, thank gosh.
If you have not heard it, you probably don't care. But Taylor Swift and Travis Kelce got engaged, which is they call them the Swifties, the big Taylor Swift fans. That's
Can I join that club?
I think it's free to join. So
really,
yeah.
I might join.
Except it costs a lot of money to go to her concerts. So good luck.
Yeah, I can't think of one song does she sing songs?
Yeah. She's had a lot of hits. She had her Eras tour because she had so many different...
You almost said Eras turd.
Yeah, Eras turd. It's a hard word to say. But the reason we're going to look at Ralph Lauren, I'm going to kind of jump ahead here, is... And this kind of blows me away. And this speaks, I think, to the market that we're in right now. But they talked about Ralph Lauren was featured in the engagement photos that were shared on social media. And that's good news for the clothing maker, according to Jefferies, for a company that states it is not only in the clothing business, but in the dreams business. We view this outcome as mission success.
What is a dreams business?
Yeah, I don't know.
I think people dreaming about...
I think it's kind of like the luxury business, right? Like Ralph Lauren is not like you go to Walmart and you buy a cheap T-shirt there. They're in the aspirational retail, the higher end retail. I think that's kind of what they're alluding to. But to me, them wearing Ralph Lauren in a engagement photo does not warrant an upgrade to the stock. That's such a short-term movement. Like, are people really in a year going to remember... Travis Kelce and Taylor Swift were wearing Ralph Lauren, and
I better wear it too.
I better wear it too, or I better buy the stock. So
I think my wife has some Ralph Lauren clothes, but
yeah, I mean it's a popular brand. Yeah. I mean it's just I don't know.
Popular brand. Let's see if Taylor can move this price on this stock here. We're going to take a look, see if it's worth buying. Company again, Ralph Lauren, symbol RL, apparel manufacturing. That's the industry that they're in. 5% short on the float, not too bad. We do see a PE ratio of 23.7. That is above the industry at 20. Price to sales 2.6 versus 1.1. Price to book value 7.2 versus 2.8. And price to cash flow 16.6 versus 11.3. And we say that these evaluation ratios, you want them lower, not higher like Ralph Lauren is in the industry. We do see a PEG ratio 2.9. Not terrible, but not great either. We do see that their earnings were last year up 20.8% versus 29% for the industry. Sales were up 9.6%. That's very good because the industry was down 2.2%. They do pay a small dividend, 1.25%. They use 26%. The earnings to pay that out. Look at the balance sheet. Current ratio pretty good, 1.8, about the same as the industry at 1.9. Debt to equity 1.3 versus 1.6. That's getting up to the higher limit, but still okay at 1.3 with other good positives with the company. Net profit margin 10.9 versus 5.4. So every outfit you buy for $100, that virtually means they get about $11 from that outfit on average. We do see return on equity 31.6 versus 24.1. Chase, what do you got?
Yeah, so current price here for Ralph Lauren, it's $296.93. Looks like the 52-week range, the low here, wow, $168.88, and the high, $306.34. I mean, obviously, they got hit pretty hard earlier in April with the whole tariff announcements. I'm sure they import a lot of different products from many different countries, those Southeastern Asian countries, I'm sure. I'd be curious how much that would be, though, because that could have lasting impacts. Those tariffs are not zero. So
right.
We'll have to see how those all kind of shake out. Now, going forward for, again, Ralph Lauren, their estimated earnings per share, we go out to March 2027. I see it's $16 a share. It would give us a target sell price here at $265.60. So it's definitely expensive. I mean, it's trading at, I'm going to say, nearly 19 times those future earnings.
And I do see over the last 9 days, the earnings are up. I mean, I show them going from $15.02 up to $16 per share. But what worries me is we are seeing the higher end, the Hermes, the Louis Vuittons, the Chanels, that they're really coming down in value. I mean, I believe at one time, the head of Hermes, I think it was the richest man in the world. That's long
that was
gone.
Louis Vuitton.
Louis Vuitton, okay.
Bernard Arnault.
There you go. Yeah. So, but I think that's going to start filtering on down through because now you're getting into the Ralph Lauren's, the Coaches, the stuff like that. I think they're the next one to get hit where people are just going to trend down even a little bit more.
Yeah, trade down to the Targets of the world,
Yes.
So
And we talked about Target before. Target may be a good buy now.
Yeah.
So we've talked about that. Well, let's move on to cruising here. You want to talk about a cruise line for a change?
Well, let's look at Viking Holdings.
Yes, Viking Holdings. I love cruising, but I just get seasick, so I can't do it, unfortunately.
You like the concept, don't like the action.
I love the concept. If you don't get seasick, I highly recommend you cruise. But let's take a look at the Viking Cruise because they are in the travel service industry. Only 4.9% short on the float side. PE ratio is kind of high, 33.7 versus 26.1. Price to sales 4.9 versus 3.1. Price to book value very high, 103 versus 8.9. And then price to cash flow is 12.5 versus 13.3. Those numbers, you want them lower, and the only one that's lower is price to cash flow. So I'm a little bit worried. Don't understand the price to book at 103. That's very expensive. We do see that on the earnings, nothing there on the earnings. We do see sales for last year up 17.7%. That is about the same as the industry, up 7.2%. They did not pay a dividend, unfortunately, so no dividend there. I remember Carnival Cruise Line used to pay a nice dividend before COVID. We do see that current ratio on the balance sheet, not very good, 0.6 versus 0.9. But again, we always talk about on these cruise lines how when they receive money for these tickets, that's actually a liability. So it really throws off your numbers. And that's why it's so important to understand the numbers when you're reading these financials to understand what they mean. I don't know if that has something to do also with the debt to equity at 20.6 versus 2.7. That's a very, very strange number. We do see a net profit margin of, 14.1 versus 11.7. Return on equity, 252% versus 89.6. I think that very low equity. Yep. What do you got going forward for Viking?
Yeah, so current price here for Viking Holdings, again, their ticker symbol is VIK. It's $63.62, 52-week range. The low here, $30.75, and the high, $64.11. So even though we're not liking the numbers, well, it looks like the stock has done well. But I go forward here to December 2026, estimated earnings per share, $3.16. Gives a target sell of 52.46, so definitely expensive.
Yes, exactly. All right, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You got that free newsletter there. Goes out every Friday at 5 o'clock, and see past newsletters there as well. So smartinvesting2000.com. We'll be back next week right here on Smart Investing.